Hey, what's up, everybody? Kendall here with the Wealthy Legacy Journey. Today, we're going to be talking about how to build wealth. And the reason I feel like this is so important is building wealth really is a journey. And every successful journey really needs two things. Number one, a map, and number two, a reference point. Now, for us here at the Wealthy Legacy Journey, the map and the route, that plan of action, that's really all wrapped up inside of Double Dare Your Money. Well, we start off with $74.58 and we continue doubling it over and over and over and over again as we build wealth. 75 basically to 150 to 300, 600, $1,200, $2,400, 5,000, 10,000, 20,000, 40, 80, 160, so on and so forth as we build up wealth, starting with a very small seed. But the reference point is what we're looking at right here, and that's our wealth health checkup. And so it's important for us to have a tool like this to figure out where we're at, right, on the map, so we can figure out where we're going. And so a part of this wealth health checkup tool is really meant to go with Double Dare Your Money. If you haven't checked out Double Dare Your Money yet, make sure you go check that out. But we start with a small seed and we build it up over time. First off, I want to say that you're not going to be able to edit this sheet right here when you first pull it up, but you can get your own copy of it if you go to File and Make a Copy. So the link to this Google Sheet is going to be in the description of the video down below. So make sure you get it, open it up, and then make yourself a copy so you can fill everything out. We're going to start off here with the main template, and then I'm going to walk you through a bad wealth health all the way through an amazing health wealth checkup and show you what some of those differences look like, how the system works, why it works, and all that kind of stuff. So let's start over here with our main template, and we're going to start off with step one of three. So whenever we're building wealth, there's really three main steps that we kind of focus a little bit on. Step one, then two, then three, maybe back to one, then two, then three. And then it's really kind of a balance between two and three at that point as we continue to build our wealth, increasing our net worth, creating that buying power. But on creating positive cash flow, I find for most people, this is such an important place to start, is just getting control and discipline with the budget. So the cash flow is essentially going to take the income minus the expenses. You'll have a surplus or a positive cash flow if your income is greater than your expenses. And in the case that your expenses are greater than your income, you're going to end up with a deficit. Now, there are four different types of income, and there are four different types of expenses that we lay out here. Now, each of these cells, one's with the little dog here, this little triangle in the top right, it explains a little bit further what I mean for that particular cell. So as you guys know, with the Wealthy Legacy Journey, we have four different income types that we define. Active income is trading your time for money. This would be like your day job, your side hustles that people pick up, all that kind of stuff. Active investment is trading your time and money for more money. So this is a lot of what we do inside of Double Dare Your Money, where we go to estate sales and garage sales at the lower level. At the higher levels, we go to tax sales and then flipping houses and land development, all the different things that I've been doing over the last half decade that I'm now showing you guys how to build from a small seed, step by step, in Double Dare Your Money. Passive investment is another thing that we're working towards. Libby and I are working towards this personally. You can see that on the Wealthy Legacy Journey. But also one day we will get there with Double Dare Your Money as well. Once we have enough capital gains, we have enough capital, we can start reinvesting into passive investment income. This is great. This is just trading your money for money. This would be like a rental house with management company. This would be like buy and hold stocks. This could be lending money, owner financing different properties, and things of that nature. Finally, there's passive income. This is trading nothing for money. This would be like Social Security, pensions. And I know you did some work for this at one point, but at this moment in time, you're not having to put any more value into the system. The system is just giving you value back out. So those are the four different income types. And so go through here and basically denote how much of each of these income types you're putting in. The reason that some of these are red, specifically active investment and the passive investment income, is because I think a lot of people get trapped here on building up their active income, but they don't think about or try to figure out how to build up active investment income and passive investment income. Or I can't tell you how often I hear like, man, Kendall, I wish I just had 10,000, 50,000, 100,000, whatever it is to get started like you. And I tell people I didn't start off with what I have right now. I started off with a very small seed and then I grew from there. And that's why we're recording and going through Double Dare Your Money. On the expenses side, there's taxes, tithe, and then there's the needs and wants. And this is important to really identify what's a need and what's a want. So in the needs, you have like house, groceries, clothes, etc. And in the wants, you have like events, eating out, vacations, all that kind of stuff. So a lot of times what I find is people's expenses is too high and their income is too low to balance it out. And so they either need to create more income inside of their household, or that's more the longer term plan. The shorter term plan is looking at the expenses and saying, how can we cut back now so we can have a more fruitful future? So that's step one, creating positive cash flow. Once we've taken care of step one, then we move to step two, creating a positive net worth. So just like on creating positive cash flow, that's income minus expenses to find your cash flow. On step two of creating a positive net worth, it's assets minus liabilities to create the net worth. So on your assets, we have three different types. We have no cash flow assets you own outright. These are things that are just collecting dust or probably depreciating over time. They don't cost you money to keep them, but they're not earning you money over time. Their purpose in your life isn't to earn you money. They're usually just for enjoyment. These are like furniture, cars, electronics. For example, for me, it's the iPhone that I have sitting right next to me. Every time they come out with a new model of iPhone, this iPhone right here depreciates. But with that said, I bought this just for pure enjoyment, for use. I did not buy this iPhone as an investment. Income producing is another type of asset. This is assets that are going to generate a positive cash flow over time after all costs are paid. It's like rental house, stock with dividend, notes. But if I say like a loan note, note here in the asset column, this is going to be money that you loan to somebody else, not money that was loaned to you. If money is loaned to you, that's a liability. If you loan money out to somebody else, that becomes an asset. Finally, you have capital gains. These assets are likely to go up in value from the time that you bought them, whether they ascend in value or you bought them undervalued and you sell them at full value. There's no intended payment structure out to you over time while you hold on to it. That's the differentiating factor between capital gains and an income producing asset. Income producing asset creates the cash flow over time. Capital gains just gives you one big payout. This would be like your 401ks that increase in value over time, but they don't pay you out monthly. S&P 500, if you were just to invest into that, into the index, you get paid out, as it increases in value, your net worth goes up, but it doesn't pay you out monthly. Buying raw land like we do at the tax sales, we're buying it at 30 to 50% of its value to resell at 100%. Well, that's something that we're buying with intrinsic value built in, and then we're going to resell at the top of the market. Again, capital gains. On the liability side of this column, you have your total debts owed. This is everything you personally owe and you're responsible for paying back right now. So if you have car payments that you're paying on right now, it'd fit there. Credit card payments you're paying on right now would fit there. According to Robert Kiyosaki's methodology, which I really appreciate his in this sense, and you make your decision here, but he says that your personal residence is a liability because all it does is drain money out of your bank account. It does not put money back in. I personally agree with that school of thought, and so I would put my home and my house payment here in the liability column as well. The next type of liability is promises. This is everything you've committed to paying for in the future, but it hasn't come due yet. So let's say that you said, hey, I'm going to do a kitchen remodel, and it's going to cost me $10,000, and I have to put 10% down now and 90% when the job's done. So you are going to spend $1,000 now, but someday in the future, when the kitchen remodel is done, you're going to owe another $9,000. This isn't debt that you owe right now, but it's a promise to pay somebody in the future. That would be the type of something that would fit inside of this promise area. And then there's also co-signed notes. So this is everything you've committed to paying for somebody else in the event that they stop paying. You're not necessarily responsible for it today, but one day you might be. So if you co-sign on a house or a car or anything of that nature, where if the main signer stops paying, you'll be responsible for it. That would be a co-signed note. And I would tell you guys, there's a note section on a lot of these expenses, incomes, on the assets and liabilities. I think it'd be great to just track what's going on here and help, just give you a better picture. And so, again, the net worth is going to be your assets minus your liabilities. Once we get to a positive position with our net worth, then we really start focusing on step number 3 of creating positive buying power. And so we broke this buying power down into 3 different categories. Liquid assets, which is any asset type you could sell and get cash for, or it is cash in and of itself, within 24 hours to be able to purchase something else. So gold, silver, Bitcoin, stock, cash, etc. Private money and lines of credit are both other people's money, but private money is other people's money. They want to give you their money for a piece of the action. This would be like a joint venture. If they give you $10,000 to invest into a $12,000 piece of property, but they wanted 50% of the deal when it's all said and done, that would be a joint venture. That would be private money in a joint venture type. Lines of credit would be other people's money, and they want to loan you their money for a guaranteed rate of return, whether the deal you invest in works or as you would hope for or not. So this would be somebody who's like, I'm going to loan you money at 12% annually. So simply 1% a month. If they give you $100,000 and it takes you 6 months, they want their $100,000 back plus 6% because you added a point per month. That would be $6,000. So at the end, when everything's all said and done, they want $106,000 no matter how the deal went. If it went amazing, if it went okay, if it went great, if you lost money, wherever it is in that spectrum, they get that back. And so those are kind of the three things that we focus on. First, cash flow. Second, net worth. Third, creating positive buying power. And again, I want to remind you guys that in order to download this sheet so you can go ahead and fill in your personal amounts, you go ahead and fill in these areas, go to File, make a copy, and put it onto your computer, into your Google. And so that way you can go ahead and fill all of this stuff out. With that said, I want to show you guys some examples of some health reports. So let's start off with a bad wealth health. So you can see immediately when we click on this, there's so much red. I want to contrast this for you because all of this is like automatic color coding. Here would be amazing wealth health, and you can see how that changes. So for example, if I were to come in here and say I made not $8,000 but $80,000 a year, boom, all of a sudden you create positive cash flow. So this is really cool because it color codes it for you as far as how you're doing inside of each category. So this person right here, let's say they're making $8,000 a month, right? But their expenses out, they're paying $2,400 in taxes every year. They're not giving, and they have $6,000 in the needs column. Probably most people that are in this situation, they put too many things in the needs column, things that shouldn't be in the needs column, things they don't actually need. And you can see they're also building up $3,000 a month in wants. These people are spending credit cards like crazy, and they are building up a deficit that's only building on itself every single month. And I would say if you're buying a TV on a credit card, that TV that you bought month one, that was a want. That was a want that you spent. But now it's on a credit card. You have to pay the credit card bill or they'll push you in towards bankruptcy. And so that's a need. You need to now pay that credit card bill. So that's how I would differentiate those. The payments go into needs because you need to take care of those and you need to get those taken care of and knocked out. But the stuff that you're buying with those credit cards, most of the time it's bad consumer debt, which would make it just simply a want. And when we look at the assets, they've got maybe $5,000 of stuff worth of stuff around the house, nothing producing income, nothing to create capital gains. You can see they have no active investment income, no passive investment income, no passive income. It's simply just what they do for work. So if this person stops working, they're up a creek. They're already up a creek as is because they're losing money every month. But could you imagine if they lost their job? And then if we look at the liability side, this is all the debts that they owe. So let's say they have a nice house, they've got a nice car payment, they've got credit cards, they've committed to remodeling their kitchen, they've, co-signed on somebody else's car note. They've got all the things that you should not be doing in their lives right now. And they have a net worth approaching $500,000. And when we look at their positive buying power, they have no liquid assets, no availability of private money, no availability of lines of credit. There's absolutely no way for them to start creating wealth. They're spending money, in this case, faster than they can even make it. So as this person starts to become aware of where they're at in their wealth health, and they realize, this is kind of where we're starting to get a little bit of a reference point of where we're at so we can place ourselves on the map to start moving forward, they're going to start moving, hopefully, from a bad wealth health report to up to the next category of a poor wealth health report. You see there's a little bit more green on this report. Let's talk about why. The income didn't change, right? So in order to create these positive cash flows, two things that could happen. They could increase their household income, which I find to be more difficult in the short run, or they could decrease their expenses, their cash going out. I find that to be much easier to do quickly, right? So they still have the same amount of taxes, but they start to realize we don't actually have $6,000 of needs. We only have $4,000 of needs, and they start to get their priorities straight. They also narrow down their wants to only $1,000 a month instead of the previous $3,000 a month. So they cut a lot of expenses out of their life. And all of a sudden, they're finally at this cash flow surplus where they have $600 a month coming in. Now, they don't take that $600 a month and just spend it, right? Or that's going to put them in the exact same place. They got to start carrying themselves out of this hole. So if we skip step 2 and look at step 3 right quick, you can see that they start building up these liquid assets. If we go back to step 2, look in the asset columns, you can see that now they have some stuff around the house. They have a couple $1,000s cash. They've got some stuff that they could sell for capital gains. They could liquidate quickly, such as stocks and gold. They still have all of those liabilities from before and the debts owed, right? They still owe the truck, on their car payments, their credit card payments. They still have the nice house. They've taken care of that promise. They still have that co-signed note. So there's still a lot of negatives, but you can see how in this situation, they're taking some steps in the right direction. Really, that first thing, that first mountain that needed to be conquered was just getting in a place of positive cash flow. But let's say that you're in a place where you have positive cash flow and you're looking on how do I begin to just create a positive net worth? Again, that's a lot of what we do in Double Dare Your Money is we show people how to start really crunching into this active investment income column, and then eventually will turn into passive investment income column. It's what I'm working on right now in the Wealthy Legacy Journey. And so this is what the Wealthy Legacy Journey and Double Dare Your Money really focuses on, is the active investment and the passive investment column, how to beef those up. So as we move from poor wealth health and over the next couple months, we continue to make the right decisions, we move into okay wealth health. And so on this one, you can see there was a little bit of change, not a ton of change, but a little bit of change. We brought our active income up, right? We were able to breathe a little bit inside of our budget. We got another $500 going to wants. We have some money going to giving. We were figured out some ways to maybe decrease our tax load somehow, which is definitely possible to do. And all of a sudden, you're running a $1,700 surplus every single month. That's cash that's able to go into savings to prepare its way to go out into investments. We don't need to just hoard a bunch of cash. That doesn't really help us, but we do want to invest that money. So this is somebody who's really starting to build up some significant savings. This is somebody you can see here. They own their car. They have some cash. They've got stuff around the house. You know, they don't necessarily want to sell their car. They don't necessarily want to sell the stuff around the house, but it is stuff, it's available if they needed to liquidate it in case of an emergency or in case of a great deal. They could liquidate it if absolutely needed in order to be able to take advantage of an opportunity. And again, they have some capital gains going. But another awesome thing that they did to really help them in this journey of building wealth was they sold a really nice house and went down to I would say a cheaper house, a less expensive house. So just so you guys know, at the time of this recording, I live in a mobile home. I live in a manufactured house. And the reason I live in a manufactured house is to keep my cost of living low. So that way I can work on creating a positive wealth health portfolio as I continue to work my way upwards from here. So if you guys look back to the very beginning of the Wealthy Legacy Journey podcast, where I started my third time to $100,000. You know, the things that crushed me the first 2 times after I crossed that 6-figure barrier when I was trying to push the 7 figures was I really got messed up on my wealth health checkup looking back on it. So this is something that Libby and I personally use. And this is something that, you know, I would say when we started, we were probably in the bad wealth health because actually I had no income. We were just draining off of savings that we had built up from the previous businesses. We were trying to launch another business. Then we moved to poor wealth health. We paid off our debt. We got to okay wealth health. We are currently in the good wealth health, and I would say transitioning to the great wealth health. But let's look at good wealth health here. So you can see in this, this person now has not only the $10,000 household income, actually this household, this example, but there's also $5,000 that came in this month from active investment income. So they were able to bump up their wants again by another $500, give themselves some more breathing room. They've got a full 10% tithe and giving fund. They have, you know, 20% taxes, going to taxes. And all of a sudden now when they're looking at, there's $4,500 that month of a cash flow surplus. $4,500, a little more than the total needs column put together in positive cash flow. That right there, ladies and gentlemen, is powerful. And so I'm in this phase, transitioning to the great wealth health phase. And I can tell you guys, if you haven't experienced this, getting to this place, as I've been there a few times, it is just such a load off of your chest, such a weight of relief. And that's why I recorded Double Dare Your Money, was to show people exactly how to get to this point. You know, the Wealthy Legacy Journey, we talk about how to get to this point, but Double Dare Your Money, this right here, you see this green right here, active investment, that income feels so good. That's exactly what we do inside of Double Dare Your Money. So if you want active investment income, make sure you check it out. There's also some, we're building up some in the cash flow column here. We've got some assets held in capital gains. Notice we added land to this list because one of the things we do in Double Dare Your Money is we cross the $10,000 threshold to $100,000. We start investing into tax sales, which is so exciting. And it gives us a way to be able to employ more money into the market at one time in a single deal to still get those high yield returns. You can also see on the liability side, we sold that nice truck. This is something I actually had to do personally. I sold my nice truck to help get out of debt, where everything I have left currently at this time is my house debt. And so now, even though we're still in a negative net worth position, your deficit at this point is only, in this family's example here, $160,000. We've gone from almost $500,000 of negative net worth to only $160,000 of negative net worth. Another cool thing is happening here because people are seeing success with what you're doing in some of your active investments as you're going through. People are like, hey, I want to be involved in whatever you're doing because whatever you're doing is working. Can I give you some money and you invest it for me and I'll take a cut, you take a cut. And that feels awesome too. It just only helps to expedite the journey that you're on. Then we have lastly great and then amazing. The great wealth health is, this is where things start getting really good. Our active income hasn't changed. Our active investment income has now surpassed our active income, and we're building up this passive income. And you can see in this situation, we also are able to bump up our wants above our needs expenses. So we have $4,000 in needs, $5,000 in wants. We're able to tie $3,000. We're going to give $3,000 a month. Some people have this negative connotation with money because in their mind, they feel like, well, money is bad. Money is evil. No, the love of money is evil. But if we utilize money as a proper tool, look how much we can give. Look how effective we can be at this point, how much we're able to give. And you could give even more. This is just kind of an example scenario. There's $12,000 a month coming in surplus funds. You're just turning that around and reinvesting. Our asset columns, look at this. This is the first time that step 2 has been green this whole time because we have a positive net worth. Look at that. It's so exciting. And so we've got $50,000 in assets. We probably own both of the cars cash now. There's still some stuff around the house. We still got some cash there. We've got income producing assets, maybe $75,000 in like owner finance notes from those tax sales. A little hint of what's coming up in Double Dare Your Money. And then also we've got capital gains here of a specific land that we bought just for selling at a higher price for capital gains. We do still have the $200,000 owed on the house, but our assets outweigh our liabilities at this point. We have $175,000 surplus, plus we've got $30,000 or so in liquid assets just always sitting in the account, always looking for a good deal. And we've got $500,000 of money at this point banging at our door saying, hey, can you please use our money and get it to work for us? We don't know how to do this. But you guys, with Double Dare Your Money, the Wealth Legacy Journey, have learned how to implement capital into the market to see returns. And that's what people are looking for. And you get to help people do just that. And finally, that takes us to amazing wealth health. Look at this. Isn't that, look at all the dark green. I mean, just the positive success. I want you guys just to like, look at where we started at bad wealth health, all of the red, all the way up to amazing wealth health here. And so at this point, you know what else is exciting? Look at this. Active income, 0. You ever wanted to be in a position where you didn't have to work if you didn't want to? Now you're in that position. Also, look at this. Passive investment income, $15,000. Do you remember how much money you need to live? $4,000. You remember how much was kind of comfortable? Was when you had $4,000 in needs and $2,000 in wants, and you had $6,000. But even when things were good, in your income at the top, you were making $10,000 of active income. Now you're making more than your active income and your passive income. How exciting would that be right there? you've been able to, you're paying more in taxes, but there's other ways once you kind of get to this level to learn how to get creative with that. Look how much you're able to give. You're giving what you needed to live. What you need to live every month, you're able to give that every month. And you know what's cool? Let's say you're like, hey, I want to be uber generous. I've got $8,000 a month in surplus, but you know what? I want to give $12,000 a month. I want that to be my biggest expense. Boom. We're still creating $10,000 a month in positive cash flow. You're giving away as much as you're taking home here. That's 8,000 plus 4,000, $12,000 that you are taking home to use. $8,000 in wants. You're still giving away $12,000 a month, guys. Almost $150,000 a year. And look at this asset column. Isn't this a beautiful? You have $150,000 in assets that you just own outright if you needed to liquidate anything. You have $300,000. I would say this is probably notes if it's creating $15,000 a month. Some pretty short-term notes. You probably got a lot of like smaller short-term notes, but you could definitely build something like this up. Owner financing land, as we're going to do inside Double Dare Your Money. And then you have about $1 million of real estate being held to create that $25,000 a month. And these are just kind of mock numbers, but this is the general direction that we are going, just to kind of get the wheels turning of what's possible, what can happen here. And look at that freedom. The freedom to be able to say like, hey, you know what? This month something came up, and maybe it's not every month you give $12,000. You're like, hey, this month a big need came up. We're going to donate an extra $8,000. But you know what? It doesn't even hurt us. We don't go into the red. Yeah, it sucks down on some of the cash flow, but we're good. And hey, you know what? Let's also take a moment to look at this creating positive buying power, because we got $100,000 sitting in the bank. We've got a $1.250,000 net worth, a $1.2 million net worth. We've got $5 million of private money sitting there begging to be used and employed or deployed into the market. And so this is where we are going. So going back to the main template, I want you guys to remember, it's simple as file, make a copy, take a copy for yourself to your Google Drive, and then go ahead and come in here, enter it, put in your amounts, put in your notes, your amounts for income, your amount for expenses. See it. If you have a positive or negative cash flow, put in your assets, put in your liabilities. Do you have a positive or negative net worth? I see both positive and negatives on the cash flow. Most people coming through have a negative net worth to begin. Most people have a little bit of buying power, a negative net worth, but they do have a positive cash flow statement. So they're starting off somewhere in like the poor to okay wealth health. And so this is their reference point for where they're starting, and it gives them a great place to start. And then they can go to Double Dare Your Money. They can watch this episodes on the Wealthy Legacy Journey and start to figure out what does the map look like to take one step in front of the next, one step after the next, after the next, after the next, as you walk from poor to okay, to good, to great, to amazing wealth, health. If you want to change your family, if you want to change your life, if you want to change the direction, the momentum of where you're going, this is how you do it. I should know I've had to do it 3 times. It's not been a super fun, pain-free journey, but I can tell you that through the Wealthy Legacy Journey, I'm showing you guys how not to do it, because I've learned how not to do it. And also some of the ways that I found have really worked over the times of doing it. A lot of what I've done is in real estate. So if you're interested in real estate investing, we're going to get a lot into that as well. So I would just want to close, guys, though, with the motto for the Wealthy Legacy Journey. And that is really, I explore the unknown. I conquer new frontiers. My journey is powerful, and my wake is a wealthy legacy. So if you guys want to learn how to explore the unknown, you want to explore some unknowns to create some unknown gains, some awesome things you haven't gotten to see yet in your life, the Wealthy Legacy Journey, Double Dare Your Money. If you want to conquer some new frontiers, if you want to get into this category here of active investment and passive investment, which you absolutely should if you want to experience financial freedom, the Wealthy Legacy Journey, Double Dare Your Money. I'm going to show you step by step how to get there. If you want to have a powerful journey and you want to be able to leave behind a wake of a wealthy legacy to change your life, your family's life, families around you, and other people around you, want to be able to change other people's lives with what you do, you want to be able to change the world around you, this is how you do it. Join us at the Wealthy Legacy Journey. Join us and double dare your money. Stop settling for what everybody else settles in. poor, okay, maybe even good, and start aiming for great and amazing wealth health. So with that said, guys, this Google Sheet's going to be in the description. You can go get it. Just file, make a copy. You have a copy for yourself. Go ahead, go in there, fill it out. Make sure you know where you're at. Then go follow us at the Wealthy Legacy Journey and go check out Double Dare Your Money and see how you can double dare your money. I really would appreciate if you guys would like this video, subscribe, and I will see you guys on the next videos. Awesome hanging out with you guys. Bye, y'all.